Do you guys have like a scorecard or some type of way of systematizing your capital allocation decisions?
One would be like, what are we looking for? And that for us, we call it OCP, like Opportunity Company Partnership. And so we're sort of looking at the macro, like how big is the market and who are the players and those kinds of things in opportunity. How is it changing? And then the company itself, like the team, the technology, how much traction they have.
How do these companies find you guys, or how do you guys find them? Because Australia is a huge place geographically, but if you're investing in companies that might be regionally based.
We're big believers in content. We just do ag and food all the time. A lot of people do come to us with our podcast. Someone will hear it and maybe even 6 months later, that actual founder will come to us. It sort of feels like it's inbound, but it's a result of very active outbound activity.
This podcast is proudly brought to you by Term Plus. What I like about Term Plus is its easy to use online platform, giving you access to high yield term-based accounts, providing consistent monthly income. Owned and operated by Pengana, an ASX listed company with 23 years of experience, Term Plus is democratizing access to global private credit markets. Visit termplus.com.au to learn more and read the PDS before investing. Sarah, welcome to the Australian Investors Podcast.
Thanks for having me on.
And Matthew, mate, absolute pleasure.
Yeah, fantastic. Great to be here.
I know you guys are podcast pros. You do this a lot. You're also investing pros. So we're going to talk about the business that the two of you have built, the businesses that the two of you invest in through Tenacious Ventures, and kind of get to the bottom of this huge marketplace here in Australia. I was actually thinking about this. I'll just get a nod of heads maybe for this. Do you guys know what an agronomist is? Yes. Okay, right. You're both nodding. Yeah. So one of our former analysts, he just recently left Rask. He went and studied to be an agronomist. And I was like, what on earth is an agronomist? And there's a pun in there because it's all about the earth. And it's all about soils and agriculture and these types of things. And it kind of opened my eyes to this enormous marketplace in Australia and different professions. It's like sub-industries within this whole food system that we have in Australia. Like, it's just incredible. So hopefully we get a chance to bring out kind of this somewhat hidden from the main street industry, but something that is vitally important. And we're going to blend that with VC talk. So Matt, maybe we'll start with you. You started in tech, observability, ag water systems before getting into VC. Can you tell us a little bit about that?
Yeah, sure. Yeah, my background definitely as a founder, not in finance originally, but through that journey, kind of ended up building technology to monitor water use in Australia. I mean, everyone in Australia knows that water is a precious resource. As we expanded internationally, I would end up in rooms where there were these conversations going on about water as a resource and all this kind of stuff. And I just knew there was this deep kind of wellspring, pardon the pun, of knowledge and understanding of what today we would call climate adaptive agriculture in Australia, because we've always had to produce our food and fibre that way, but we just weren't talking about it outside of Australia. And so the more I thought about kind of what next for me after the kind of founder side of my story, it just seemed necessary and important to get so much more of that know-how that's inside of Australia kind of out as the rest of the world was going to have to deal with the impact of more climate adaptive agriculture.
So maybe we'll get to this in a minute, but I'd be fascinated to know how the two of you met and did all of that. But Sarah, you had I've got this here, a gap year tomato harvest in Argentina, which kind of just threw everything in one. And I was like, that's an interesting mix. And you often say that that's kind of like formative to the way you think about business and these types of things. So what was that gap year like? What did you do and how was it formative? Like, what lessons did you take away?
Yeah, absolutely. So I'm always grateful to Australians for the phrase gap year, because in America, where I grew up, like taking 9 months off in your 20s is pretty unheard of. And like, unless you're going to be a hippie, like there's just no term for it. So gap year was a great one. But I started my career in the defense industry. I grew up in Silicon Valley. So sort of tech and business was always in my background, but not agriculture so much. And so when I did take a gap year and went to South America, I found myself living on farms originally because farms were near mountains and I wanted to go hike and climb. But eventually, because I became fascinated by agriculture and just saw so many interesting things about how food was grown, how technology could play a role, how climate was impacting how food was grown. And it kind of flipped a switch in my brain where I said, wait a second, like I'm now able to make my own decisions about how I spend my career and how I use my skills and what that looks like. And agriculture seems like this really cool opportunity to both make money. It's growing, it's critical, and it's under pressure. And so it's also an opportunity to do well. And that seemed like, wait a second, I growing up in Silicon Valley, my parents were in the semiconductor industry, and it was very much like, go make money and then do good for the world. Like those aren't the same thing. And sitting there on a farm, like harvesting tomatoes and just questioning like how our food was grown and what the future of that would look like, it seemed so obvious that that could be both. And I was hooked and kind of haven't looked back since.
Wow. So you went away and did that. And what was the next step for you when you kind of came back? Like, where did you look?
Yeah, well, if I'm really honest, the next step was like, okay, well, you have to have credibility to be in this space, like, farmers. And so I should go be a farmer. And I was like, wait a second. That seems like a very long journey to be probably pretty bad at something that a lot of people are pretty good at that just isn't aligned to my skills. And so I spent a summer sort of living on my dad's farm and toying with equipment and welding the cattle grade and was like, okay, this just isn't, the learning curve here is so steep. I have so much respect for what farmers are doing, but this isn't going to be a good use of my skills. And so ended up going kind of a journey to figure out where in the food system I wanted to play. Was that at an NGO in the developing world? Was that in corporate sustainability? And ended up coming back to this idea that technology and the people that would fund it could break this trade-off between what was seen as like small scale and good for the world and what was going to be big and profitable. And now those are archetypes and not even necessarily true. But the idea that with climate pressures coming in and with technology accelerating, the intersection of those was going to be like big potential and a lot of change. And so first for me, it was technology. And then it quickly became, well, how do you fund those businesses? And what does that need to look like that may or may not be different than how we fund other kinds of businesses?
Matthew, maybe I'll throw to you for a second. How did the two of you meet and what was the opportunity with Tenacious Ventures?
I'm laughing because Sarah stalked me on LinkedIn. That's how we met.
Okay.
So I was kind of in this phase of thinking about what next and in particular, like how we could start to build an ecosystem here to support founders. As a founder in sort of, like a proto AgTech market, it was really hard for us to find employees, to find people to be passionate about the industry. And so I was kind of in that phase. I had published some stuff on, online as you do to try and create a community, and that connected with Sarah. And then we kind of talked more and more and realized that we just had a really similar perspective on the opportunity there, which was, as Sarah was saying, like, there's these really big systemic trends around the challenges of food and ag, and it just seemed like Australia was really well positioned to maximise the decades of research and development that had gone on to make Australian farmers better, to make Australian farmers more efficient, to make Australian farmers more profitable. But in addition to doing that baseline of decades of work had global potential, and that's really what we wanted to work out how to unlock.
Yeah. It seems like kind of like the crossing of paths that's very, very fortuitous now that you've been going for so long. Maybe, Sarah, a question for you is when you started out, you drafted these kind of hypotheses about Tenacious. Looking back on them now, like what were they and how have they gone? How have they played out?
Yeah. So when Matthew and I met, and yes, I did sort of stalk him online, and then he was very kind to, be generous with his time. We got to know each other more. But at that time, I was running a consulting business. And so we were helping to build the ecosystem, but doing strategic work with corporates and industry and research. And I kept seeing, and we kept seeing that there were really amazing companies that sort of didn't match the template of venture capital. And that seemed like an opportunity. And that was something Matthew and I in particular kind of resonated about. I remember one time we were judging a pitch competition, and there was like all the judges that picked, this other company software, and they looked like ex-consultants and they sort of fit the mold. And Matthew and I were like, wait, this other company where the founder sort of has this non-traditional profile and is building a hardware thing and doesn't speak fluent venture capital. So there were a lot of moments like that where we got along and had the same worldview, but also kind of led to these hypotheses, one of which was that being sector specific and having high conviction in this space would unlock potential, not only companies getting funded, but more capital to come in. And I think that's really been true, that understanding ag, spending all of our time here, having the advisory business that gives us unique insights, having farmers as investors, we can kind of see things that others don't and be connected to things that maybe others aren't. And then that support piece, we do end up finding and backing a lot of companies where the teams maybe come from ag or the ag side of things or research or technical side of things and don't have the kind of fluency with venture capital or don't know what it looks like to build a startup in a traditional way. And so we can help to bridge that gap. So that one, like sector specific, kind of high conviction, high support has really, I think, played out. Now, how we do that support and how to not have too much ego in it. And, they're running the companies, not us, like lots of lessons and insights around that. But I think that one's really played out. Another one was around climate impact, so that food and ag is under massive pressure and that it's not just an opportunity to decarbonize. Obviously, that's really important, but that there's actually a real economic opportunity around the risk that our food system is exposed to because of climate. And that will create commercial imperatives for adoption and for new ways of doing things. And I think that's also played out. I mean, don't have to look very far in the news to see with floods and fires and smoke taint and wine grapes and all kinds of things. And so there just is a lot of pressure on the system that require new commercially viable solutions. And so that for us has meant aligning that impact and commercial piece. And we look for things that don't necessarily have a green premium or don't require this kind of do-good attitude to buy it, that there is a commercial incentive. And so that one's kind of played out as well. Faster, slower US views on climate right now, like it's bumpy, but generally the trends are going in the direction we thought they would. And then the third one was around what we have said is kind of digitally native agriculture and this idea that technology would be getting better, faster, cheaper, and would unlock new opportunities to build solutions in the food system. I think that's been true. What has been interesting is the perception when we said digitally native agriculture was often that, so you're going to invest in software. Like, agriculture is not as digitized. You need a bunch of software and you should sell software to farmers. And that's probably like the lowest on our list of the kinds of things we'd invest in. And so we tend to look at a lot of deep tech solutions, more in the realm of atoms and molecules than bits and bytes. And so not so much that we changed our view on that, but we've had to evolve how we do that, how we attract investors, and how we talk about it so that people understand, what do we actually do.
It's fascinating. I remember going to some micro cap conferences. These are more public companies, and just pre-IPO companies, not pre-seed, and seeing some of the technology. And people can listening to this or watching this can relate to maybe the idea of a drone going over a farm and measuring crop yields automatically. Or measuring the temperature or the climate in advance or the weather in advance so farmers can accurately determine if they, dust or if they fertilize today or tomorrow or next week, or just getting way smarter and more intelligent with things. Matthew, now people have these ideas in their head, right? But can you give us a sense of how big this marketplace is?
Yeah.
And it might only be through your lens, at Tenacious, how big is it in your world? Or how big is it in the entire kind of ecosystem and universe? However you think about it.
Well, look, it's big, just at an Australian level. So over half the continent is dedicated to agricultural production, 55% of the land mass. The commercial value of that land, so farmland as an asset category, is about $3.6 trillion. I don't remember last time I checked super, but I think that's about the same amount of money that's the entire Australian superannuation scheme. I believe that's about 50% higher than the total market capitalization of the ASX, right? So at that level, land area wise, it's enormous. The kind of impact on the country and our relationship, to land and country economically, it's huge. And so from that scale, the kind of macro scale, it's not at all surprising that we see Canadian pension funds coming in here and investing in Australian agricultural land. The improvement in the underlying asset value has been very significant. It waxes and wanes a bit. So kind of at that level, enormous. More at the kind of micro or meso sort of scale, farm gate output in Australia is about $100 billion a year. That's just literally the value of production. Profit on that is about $16 billion. And so when you think about, the role of a technology that improves on farm efficiency, small improvements in efficiency, and especially most of that variability comes from factors relating to weather and therefore ultimately climate and markets, both in terms of pricing of inputs and outputs, but also just the conditions under which farmers have to. So then when you kind of zoom into the power of technology, small incremental improvements on farm, really have a massive opportunity availability. So that's kind of the lens through which we look at it at a kind of gross economic scale.
I like many people that listen to the show, perhaps I'm a big fan of Clarkson's Farm, which tracks the journey of Jeremy Clarkson in the UK trying to build his farm. And for anyone that hasn't seen the show, it's all about agriculture and farming, just somewhat hobby farm, somewhat business, and the difference that planting a week late or a week early, or whether you're monitoring a particular paddock can have significant impacts. And the not to take too much away from anyone who hasn't seen it in the show, the spoiler, but in the final episode, they always talk about if the farm's made a profit. And one year it swings from like huge losses. The next year it's massive gains. And they're like, it's not that different season to season what they actually did. And so if you can incrementally improve those things, it's a massive opportunity. How did you guys take that idea of, say, this huge marketplace, tremendous opportunity, both for farmers, but also just commercially for the two of you and the business and the companies that you support? How do you whittle that down to something that this is our focus area? This is what we want. This is our part of the market that we want to play in. Either of you can answer that, but I'm just curious.
Yeah, so we, I guess the first answer is just where do we invest? What's in mandate for us? And obviously that discipline is important. We think about systems change and we think about the interconnected nature. You might have something that impacts farms but is adopted upstream. But the easiest way to explain it without going into all that complexity is pre-farm gate. So genetics inputs, things that are happening that then get sold into the food and fiber landscape, things that happen on farm. So actual, everything from management decisions to robotics and pest management and carbon and all of those areas. And then into the supply chain as well. So post farm gate, we would look at processing, packaging, waste, and even into ingredients. So novel ways of creating food products or packaging them or those kinds of things. What we don't do is food companies. So Australia doesn't have a particularly large consumer market from a climate perspective, not particularly impactful. And just a lot of the expertise there is marketing, and that's not our expertise. So we sort of say upstream of that, anything's fair game. And that can include things into forestry and fisheries. We've done a bit less there, but as sort of all of agri-food and fiber. So that's kind of how we draw the boundaries. And then within that, we don't invest in production. So we don't invest in farming businesses. We're looking for those technology companies that have some kind of unlock around the economics of whether that's producing or packaging or processing food and fiber. So we're looking again at that kind of venture lens of high growth, transformative technology enabled businesses.
On your website, maybe sticking with you, Sarah, on your website, they did this blog post, this podcast about did Silicon Valley kill AgTech? And we'll get to the companies and all that sort of stuff in a minute that you're backing and how you think about unit economics and that. But if we just stay in the world of VC for a second, why is that even a debate? You've got the experience there. Why is that a debate that we have?
So if you look at funding in AgTech as a part of venture, jumping back to sort of 2012, 13, Monsanto acquired the Climate Corporation for about $1 billion. And that kicked off this sort of journey of people saying, well, food and ag is this untapped venture asset class. And so money has sort of poured in. And you can look at the data growing year over year into kind of 2021, 22, and then it's sort of fallen off in 23, 24, 25. And so the question is really is that true? Has that proven out that this is a really venture backable asset class that was untapped into? And then if so, where are the returns? And unfortunately, recently, we've had quite a few high profile, well-funded ag tech companies declare bankruptcy or be revalued. And so we really wanted to ask this question and sort of come out and start the conversation around, is this a problem with ag? Is it not investable? Is it a problem with VC? It's not a fit? Or is it something more nuanced? And, the title of that post was a bit intentionally provocative, but really where we've landed and what we think is true is that it's kind of neither of those. It's when you apply the strict template of venture capital that came out of Silicon Valley and has evolved to be designed for software and now AI, you're missing a lot of the challenges of the food and ag system if you're backing things that are, hardware or biology in nature, that has seasonality, that interacts with natural systems, that requires, just a different approach. And so really trying to move away from this, like, it's not good or bad and, no one killed anything. That's a bit provocative. But where and when do we need to question the templated kind of software-based venture model for food and ag, and when does it more directly apply? And that's what we were hoping to ask, and that's what we spend a lot of time thinking about, because we don't tend to back a lot of software companies in this space.
You said before that you mentioned the phrase or the name deep tech, and I'm curious, can you just define that for us? Like, what do you mean by deep tech?
Yeah, it's so I think in Australia they call it deep tech, in the US they call it hard tech, and then it gets confused. Is that just hardware? So we think about it as businesses that have some sort of transformation of atoms and molecules, not just bits and bytes. So that might be hardware and electronics. That might be more in the biology, chemistry realm. It might have a combination of the two, but basically there's some sort of physical element of the technology that they're bringing to market and the intervention that they're designing, versus the technology aspect is writing software. So often they have software elements, but it's not just software that is the kind of tech stack that these companies are leveraging.
It's really interesting because leading into today, I was thinking about like ASX listed companies and how do you get exposure if you're a public markets investor, and there isn't a lot. And if you take that perspective of what you're talking about, they're the types of businesses that you guys are looking for. I can't really off the top of my head, I don't even know if there are any. Like there might be a few, but I can't think of them off the top of my head. So, but it happens every day, right? This is our country and there's so many great farms, and the whole system is integral to not just our country, but to many countries, what we do here in this country. So getting some exposure to it seems to make like a lot of sense, but it's just so hard unless you're in your world. And I've got more questions about like how you find those types of opportunities in just a moment. But if I'm thinking about it, like what I'm familiar with is from like an outsider's perspective. I grew up on 10 acres near the Yarra Valley in Victoria. We were a farm, but it was like not a farm like we're talking about today. But I remember like things just cost a lot of money, right? Like to do things costs a lot of money. To roll out new ideas costs a lot of money. It takes time. So I guess my question to you is, when people think like, hey, software, you guys are investing in software for farmers, but you're actually doing deep tech instead. Does that require a lot more capital that you need to deploy into opportunities, or does it require more patience? Like, how do you guys think about that?
Yeah, I mean, I think it's a capital allocation question, actually. And maybe back to Sarah's answer before, maybe some part of the Silicon Valley template was like load up fast, grow fast, load in the capital. And whilst it is true that some of the approaches, indoor agriculture and these sorts of things, alternate protein production can have a capital element to their business, sometimes the mistake was to sort of like build an enormous facility straight away and sort of like misallocate the capital over time. And I think, so you use the second word there, which I think is also really important, which is patience. Back to your Clarkson's farm example, there's a phrase in AgTech investing called miss by a week, miss by a year. And sometimes you don't even get to control that. They could literally be weather. And so that patience really actually is a capital allocation question. It's not just that it takes longer, but the sort of sensible application or allocation of capital requires, some combination of patience and, a bit of good luck, obviously, between those two things. So yes, it is true that the harder tech, deeper tech companies have a capital intensive element to them. There are ways around that for sure. But I think also it's like resisting the temptation to sort of, just because the capital is available doesn't make it the right thing to do, to kind of, over allocate it too early in the company's journey.
I actually, sorry, Sarah, one second. I actually spoke to some authors the other day who just written a book about venture capital in Australia, and they were saying that like dollar for dollar, Australians actually allocate incredibly well. Like that dollar, that incremental dollar that we put into VC is remarkable. And it's probably because maybe the industry is not as big as people associate, or maybe, whatever the case may be, you guys would know more than me. But when I heard that, I was like, oh, that's really impressive. Like pound for pound, we have more, unicorns, which are billion-dollar private companies. So that's really interesting. Now, Sarah, I did cut you off. So do you have anything to add to Matthew's point there?
I was just going to say that, you could hear Matthew talking and say, well, that sounds really risky. And why would you do that? And so the other side of that equation is, yes, you can miss by a week, miss by a year. But there's this kind of myth around adoption, like farmers are really slow to adopt and really hesitant on technology. And so the other side of that coin, though, is that when something works and when it's proven, farmers are extremely fast adopters. If you look at the adoption of things like GMO seeds, for example, like that got adopted faster than the iPhone. And so like literally you can look at the adoption curves. And so once it's proven, once it works, once there's a strong value proposition, that's just not true. And then the other one is that retention. So yes, farmers might want to try something on a small plot and then a slightly larger plot. But then once they're have proven it and it works, they're extremely sort of loyal customers, and retention is the other side of that. So that really for us goes back to that sector specific piece is if you're just applying that same template, it's like, well, this company just isn't growing that fast. But if you sort of zoom out and look at it, well, maybe the fundamentals here are actually quite stronger on that slightly longer time frame or looking through those different metrics. And so that's kind of the stuff we look for. And then the other point I would make is it's not that we won't back software companies, like the benefit of software and the margins and those kinds of things. It's just that in a lot of food and ag, the opportunities are to solve a piece of the puzzle that the existing system that has allocated significant CapEx to a processing facility, to a land investment, there's these sort of unlocks for them. And some of that's in the software realm, but a lot of it's in the physical realm. So being able to use significantly less chemicals and unlock new agronomy on a farm, or being able to manage waste on site or produce fertilizer on site. And just the nature of those innovations are going to be in the physical realm. And so it's not so much that we like hardware better or anything like that. It's that the nature of the food and ag system often requires those kinds of inventions.
It's interesting, right? Because like we have a lot of investors, public market investors on the show talk about like unit economics and like scalability and all these types of things. Can either one of you share an example perhaps of like seeing that in action, like how that plays out? And maybe if you tell us what the company is and what it does, it might help frame that for us on that flat path.
I can do one. So, and I think it kind of goes to that, like, how do we diligence it and how does that change over time? Like, how do we sensibly allocate capital? So we've invested in a business called SwarmFarm Robotics. Now they are founded by a husband and wife team out of regional Australia, up in Queensland. And when we first met them, they had already built the first sort of working prototype version of their product, which is a robot, like an autonomous, think of a tractor without a cab and without a human, that itself can, move in the farm, can detect obstacles, can navigate, but then attaches to a number of implements, just like a normal tractor would. So you might attach a spraying boom, which has some sensible technology to find the weeds and not the plants, as an example, or a mower or a spreader for fertilizer. And so they build the tractor and they partner with others who build those apps or attachments. And so they had built the first prototype when we met them, but it wasn't sort of ready for, all right, let's just manufacture a bunch of them and sell them. And so like, what's the kind of capital allocation and how do they prove demand to give us and them confidence? And so one of the things they did early on, this was actually before we invested, was they sold sponsorships to put logos on the robot and to like banks and insurance companies and whoever to match fund that with government funding. And that's what enabled them to build the first prototype. And then the kind of next step was, well, we don't want to sell the robot because we're not confident that it fully works. So let's run it as a service and let's prove we can do that spraying operation commercially on a farm as if the farmer had brought in a contractor to do it. And let's get paid that sort of service fee. And then let's move to actually selling the robot, but let's have a finance partner that comes on board so that the farmer isn't paying an upfront cost, but they're paying a lease payment essentially. And so they've just sort of systematically iterated on how to fund that business, both to fund R&D through dilutive and non-dilutive funding and sponsorships and revenue, and to prove the commercial side of things until they were ready to say, okay, now we can manufacture robots. And now they have a new facility in Toowoomba at the Wellcamp Airport. They're producing multiple robots per week. They've got, hundreds of robots deployed on, as of September this year, over 10.5 million acres. So, they've grown massively over that journey, but it started with sort of, I think, under promising and over delivering a little bit. Like, we don't want to sell the thing before it's ready, and we don't want it to be out there operating on a farm if it's not actually commercially ready. And how do we find the sources of capital that enable us to do that development, not just only use equity in maybe that more traditional Silicon Valley style and just raise a bunch of money and pour that in. And so I think that's a kind of good example of that journey.
It's a great example. Did you guys own SwarmFarm in the portfolio?
Yeah, so we're minority investors since 2020 and have had, a board seat and supported that company since their first, professional investment round.
Wow, that's impressive. Is it normally when I would talk to investors, and I don't know if this question kind of lands or not, so forgive me, but normally when I talk to investors, they have like a criteria or things that they look for, like metrics or something like that. Do you guys have like a scorecard or some type of way of systematizing your capital allocation decisions, just high level stuff?
Yeah, there's probably a few that we come at it. So one would be like, what are we looking for? And that for us, we call it OCP, like Opportunity Company Partnership. And so we're sort of looking at the macro, like how big is the market and who are the players and those kinds of things in opportunity. How is it changing? And then the company itself, like the team, the technology, how much traction they have. And then we call it partnership. Others might call it deal. We like to try to start off on the partnership foot, not the deal foot, because we want both to win, not lose. But the terms and the economics of the round and the rights and those kinds of things. And so in any given opportunity, you might spend more time on one or the other, but we're sort of making sure we get comfortable across all of those areas. So that's kind of one framework. And then the other would be like portfolio construction. So we, I guess, again, for those not familiar, like we've raised a fund, we're raising our second fund now, and then we allocate that into a number of minority stakes in these private businesses. And so we're thinking about sort of how much we own of the company, how much capital they're going to need over time, and making sure we have reserves to follow on. And so another framework would be like sort of 40% first check, 60% reserve for follow-on. So we do want to come in early, but then back the winners and have dry powder available to do that. So I think those are kind of, I guess, two aspects, like how we actually diligence the company and then how we think about constructing the portfolio and following on and supporting.
I guess maybe Matthew, I'll throw to you, is how do these companies find you guys, or how do you guys find them? Because Australia is a huge place geographically, but if you're investing in companies that might be regionally based because that's better for their product or better for them to serve their customers, like what is that process? Like how do they actually come to you or you go to them? Like that seems like a pretty interesting challenge.
Yeah, look, it is. We're big believers in content and so I'm sure that we vibe on that front. And so first and foremost, we want to share as much of what we're learning as possible. And we have found that to be a very virtuous cycle. And I'm sure that entirely makes sense to you and everybody listening. So that's a place that we start, in terms of just the advantage perhaps of being a sector specific fund is like we just do ag and food all the time. And, we find that people are very generous with their time. We talk to them, we learn stuff, we share. So, a lot of people do come to us, not necessarily just the founders, but people who are supporting founders often. So, sometimes with our podcast called AgTech So What, someone will hear it, they will share it, and, maybe even 6 months later, that actual founder will come to us. And so it sort of feels like it's inbound, but it's a result of very active outbound activity. Sia and I also both have had a fair bit to do with sort of helping to construct the early stage ecosystem. And yes, Australia is big and, there's the startup support, in Queensland and New South Wales and Victoria, South Australia, WA, Tassie, everywhere. But in fact, maybe there's kind of 50 people who you probably could connect all of those early stage ecosystems together, and then the universities and the research institutions. So, look, being systematic about being connected, staying connected, really working hard to be active members of the community, putting on events, attending events, and like sharing knowledge. I guess really started from that point that we just thought that Australia, has this sort of unfair advantage in some ways. Listeners probably don't know, but something that's very unique about Australia and New Zealand is that they are the least protected agricultural economies in the world. And so that means there are no tariffs, there are no protections, there's no federal government mandated insurance schemes. So producers in most other countries in the world have economic backstops, and they have price guarantees, and they have, like what's happening in the moment in the US, they have a federal government that's willing to just literally provide aid to farmers for economic reasons. So based on that, Australian farmers have always had to be very focused on efficiency. And so that has driven the adoption of technology, to Sarah's point, like technology that is shown to deliver will get adopted. You can be sure of that.
It's almost like that the resilience has come, and it's like built these the frugality with the capital allocation that they pursue, like the farmers pursue, and also just the solutions that they turn to. People listening to this that would be probably buying ETFs or shares in their own brokerage accounts and stuff, they'd just be going in trying to find a list of companies, like all the regular metrics and stuff. Whereas you guys are kind of like, it's like who you know and who knows you is a big, big advantage, because that's what brings this in. And that's also the big part of the process, which is fascinating too. Now, you guys did mention you are raising for your second fund now, but the business has been around for quite a few years now, and you guys have been doing this. And I did actually see, like, I've listened to your content, seen you both on LinkedIn, pretty substantial followings for Australian VCs, but me, which is great to see. I'd like to maybe just turn our attention to some of the companies, and I'd just be interested if you guys can give us the bird's eye view, because I think this helps shape like exactly, you're putting your money where your mouth is, but it's also like shapes like how you think about companies and trends and themes in this sector. So I don't know who wants to go with this one, but the first one that I thought about when I looked at your portfolio page was Goterra. So who wants to go on that one?
Yeah, I'm happy to pick that one up. Actually,
Sure.
And Sarah already mentioned it. So Olympia Yaga, who was the founder of Goterra, was the person who pitched at that competition that Sarah mentioned. And so, listeners probably know, food waste is an enormous problem. Very significant percentages, a third or more of food, never ultimately makes it through to consumption by whoever it was intended to be consumed by. And dealing with food waste is an enormous problem. Goterra basically is a solution for organic waste, so food waste that needs to be disposed of. Most of it today still, unfortunately, is buried in holes in the ground. We've all seen these holes in the ground. We pretend they don't exist, but they are a big problem. The land, is very precious and needs to be used for other things, and it also creates a lot of methane and greenhouse gas. So we have to find better ways in addition to reducing waste. The way that Goterra has found is basically create a shipping container, fill it full of black soldier fly larvae, or maggots as we might call them, and the waste goes in, the maggots eat it, they get big and fat, and then the maggots come out the other end, and there's plenty of good things that you can do with those maggots afterwards, including feeding them to fish and to poultry. So a real circular economy story. That idea of, rather than thinking about these enormous facilities, shrinking everything down to a shipping container sized is like the fundamental thing that we saw and heard Olympia say. And another thing, if you think about waste, I think, it's something in the order of 80% of organic waste is water. And so transporting the waste to a centralized facility to then process it is very inefficient, especially in a country like Australia. And so this idea of decentralization, decentralizing processing of that kind, which the Goterra technology enables, just has really good unit economics to it. And so that's kind of the second thing, is a business model insight is something that we're looking for. So Olympia kind of, A, the idea of really circularizing this problem, B, the idea of decentralizing and distributing the solution closer to where the waste is generated. So that could be, for example, like in a hotel foyer, like in Sydney, at Barangaroo down in the basement, there's a MIB, or at the Hyatt, there's a MIB for all the food waste that comes out of the kitchen. Fantastic solution, really high kind of ecological credentials, and very practical. So just a really good story. Now, obviously, that's a long time. It was our first investment, in fact, in the fund in 2020. And really, from a unit economics point of view, Goterra is really now hitting their straps. They had to sort of connect the two pieces, collecting the waste we know where the waste is generated, but also coming all the way through to who wants the protein. The challenge on that side was if you're going to supply to a chicken farm or to an agriculture outfit, you have to be able to provide volume. And so that's kind of that third piece is when do we get to scale? And the exciting thing with Goterra now is they're really getting to that scale and sort of coming up to that time when the unit economics are really starting to shine.
It's like a platform business because, like, you know, people would be familiar with like Amazon or eBay or like there's buyers and sellers, and you need 100%. The buyers to get the sellers and sellers to get the buyers.
Yeah.
This is kind of like in the middle, there's like maggots and organic waste, right? So
it's 100%. I think it's very unconventional in that respect. It's like, just don't look inside the box. But yes, you're right. It is like a platform business, and you know, so there are projects now with city councils, right? Who, like, it's a fantastic service for them to be able to offer. You know, I now know where that little tub of food organics that I go to all the trouble of kind of, you know, putting off to the side. I now know that the council can take care of that in a way that's really ecologically significant and responsible, and I can participate by properly separating out my waste. So in that respect, a real platform technology.
It's a huge. I mean, I'm only kind of bouncing off you here, but it's a huge thing because, like, even in our council out of Eastern Melbourne, they're sending out more and more, you know, green waste bins, and then there's like the organic waste bins, and then there's this and that, and there's so many incentives for consumers as well to get involved in this big trend, and this is kind of right at the heart of it. Like, how do we do that at scale, which is kind of cool. Now, Sarah, you did mention SwarmFarm before, which is fascinating in itself. Probably what I'm really interested in is like how you've initially found that idea, and then also like what do you think, like if you have a thesis for holding onto that business and the stake in it, like where do you think it goes from here?
So we met Andrew and Jossie actually before we had raised the fund, when we had the advisory business, and they were a good example where they had like extreme credibility in the agriculture space, in the emerging robotic space, but the sort of familiarity with how you'd raise capital for a business like that. You know, do you go to your bank? Do you like put it on the stock exchange? Like how what even is that? Wasn't obvious to them and many other aspiring founders. And so we had met them in our advisory business and actually done some work with them before we had the fund. And then as it looked like we were going to be able to raise the fund and get that off the ground, we stopped work with them on the advisory side and sort of put them in the funnel for investment. So again, they were early. We backed them in 2020, one of our first couple investments back then. And I think the common one that people say for SwarmFarm is like, oh, well, they'll get bought by John Deere. Like they'll get bought by one of these existing equipment companies. And I think that's, look, it's possible, but it's definitely not the aspiration for them or for us in that sense, in that a lot of the things SwarmFarm is unlocking with the autonomous solutions just are counter to the incentives of some of the existing OEMs or original equipment manufacturers in that space. And so things like a dealer network, things like how you monetize support, are things SwarmFarm saying we want to sell direct to growers. We want to enable farmers in regional economies to fix their own equipment. We want to deliver this sort of premium offering without a lot of the existing margin takers along the way. And so for them, I think there's a couple possibilities. Like they could build a large, independent, successful business and end up, listing and becoming, a enabler of multiple technologies, especially because of that ecosystem that I mentioned, where they're really opening up the chance for other developers in hardware and software to build onto their app store, so to speak. And so you can imagine we've seen companies that do that kind of thing be very successful. So that's sort of one case. I think another one is we're seeing more sort of roll-ups and acquisitions in this space from other parts of the supply chain, from the precision ag providers, like the technology that sits in the equipment, and from folks sort of in the equipment manufacturing space that are building those implements. And so you could imagine sort of strategic acquisitions where they're a channel to market for an attachment, or they're a sort of complement to a series of attachments. So I think both, cases are possible, and we see a lot of potential for that business. They just raised a Series B that actually got announced in early October. So really excited about sort of where they've come from and obviously where they're going.
Yes, it's a really cool thing. I was actually thinking about the precision ag, and again, I'm going to throw back to the Clarkson Farm thing here. I remember there was a scene where they got a new tractor, and they were trying to figure out how it worked, and they're sitting in there, and there's all these like GPS things and different stuff that wasn't working. And I was thinking to myself at the time, like, I'm pretty blessed to be able to fly a bit for my job and see different cities and stuff like that. And every time I walk past the cockpit in a plane, I'm like, oh, I'm glad the pilots are in there, because I would not know how to land this thing. But when I looked at those tractors, I was like, better them than me, because my old tractor on the farm had nothing. It was just an old diesel chug along. But these new things are just incredible. Like the technology that's embedded in them. And when you said, Sarah, before that, like, it's like reminding us that farmers are early adopters and they really do invest in this technology. Like, you can actually see that, and you can understand why there's that imperative to kind of adopt it, to improve margins, to improve efficiencies. It's so, so important. Now, I don't know who kind of wants to tackle this last one that I got here, but Earthodic, fascinating business. So either one of you just jump at me with this one.
Yeah, so they're a business, actually, to your question about sourcing, they came through the website. So we didn't know them. They weren't a warm referral. They filled out the form on our website, and we ended up, getting to conviction and ultimately investing. And so whether that's because of the content, whether that's like, lack of bias, but that was, a cool outcome. And so they use materials that are byproducts of the pulp and paper industry, material called lignin, along with some other materials to formulate what is a coating. And so think of like a batch of sort of liquid that would go onto paper and board products. So if you think of like the coffee cup that you get when you get a takeaway cup, or you get like takeaway food, or you buy a box of frozen chicken nuggets or frozen seafood, or you just have paper in your Amazon delivery box. So all the paper and pulp and cardboard that we use, it's often coated with wax. And so that's so that it's resistant to water, and the sort of performance stacks up, that it's not just paper exposed to the elements. Now, Earthodic's coating is a replacement for wax. And one of the challenges with wax is that it's not the end of life for that paper. It's not recyclable, repulpable, or compostable. And so the wax coating has all those functional benefits, but means the end of life isn't as flexible to reuse that material to meet sustainability targets. And so Earthodic has a replacement for that. And I guess to the sort of like where they're up to, they're earlier in our portfolio. We invested in them more recently, and they're still removing the technical risk. So they're still proving out that the functional properties of their coating meet all the requirements of customers, that it has the right heat tolerance when you're applying it, that it has the right water resistance, that it's not too sticky when you have to stack the boxes together, like all of those properties of how it stacks up, that really applies. And as they're progressing through that, they're getting more and more customer interest to say, if we can have a solution that has as good of economics, because it's not meant to be like a green premium, we're only doing this because it's good for the world, but it also has these characteristics around end of life, then that sounds really compelling, as long as it meets all those functional requirements. And so that's kind of what they're in the middle of, is proving that out, and then scaling it up.
It's cool how you think about that, like the technical risk, and then you have like all the commercial and all that sort of other stuff. And I don't know if you guys can relate to this, but every time I pick up one of those takeaway cups, and I'm like, I don't know, when I walk past the bin, does this go in the recycling bin, or does this go in the general, or do you guys know the answer to that? Because I don't know the answer. I don't know the answer, but I see it everywhere, right? Yeah. It's a thing.
I mean, sometimes with these things, there are, what are referred to as sort of perverse outcomes that unfortunately, in a desire to go to a kind of packaging that in theory is compostable at least, but they end up kind of being streamed in the wrong place. And so it just sort of pushes the problem further downstream. So, the more flexibility these solutions have, the better. So kind of, because obviously recyclable is very different to compostable. And like if it's coated, if it's got food kind of stuck to the inside of it, so they're wicked problems in that way, right? Like it isn't just as simple as like your Coke can. It's pretty clear. So long as you drunk everything out of it, like we know where that goes. With food, it does get a lot more complicated.
Sorry, Sarah, you were going to say
I
something?
was just going to say one more thing. Like we talked before about the capital intensity of these businesses. And I think Earthodic's a really good example where we see a lot of packaging companies, but the whole model is, well, we've built this thing that works and we've got demand for it. And so if we build a facility where we can produce a lot more of it, then we can meet the minimum order quantities for our customers. And so we just need $7 million or $20 million to build the next facility, and then we'll have all this demand. It's a really tough ask, right? Like, is the demand really there? Well, you can't get an offtake contract. And so what we really like about Earthodic is they've built the formulation and thought about it to use existing infrastructure so that they can use other people's equipment to do coating it on the paper, other people's equipment to do the stacking of the paper, like all the things they need to do downstream. They don't have to build their own capital intensive facility. And so as something we look for, to your point about unit economics, it's still a technical innovation in the physical world, but they don't need to do all the pieces of production to be able to get it to scale. And so that's quite appealing to us.
I want to just ask some final questions around like the portfolio and how you bring it together at Tenacious Ventures. You mentioned like Earthodic is kind of in that technical stage. Can you give us a sense of like how big are these companies and how big are the check sizes that y'all write for these companies, like in simple terms?
So relatively small, imagine for what most folks listening are thinking about. So our first fund was $35 million. We invest in 14 companies. And again, we sort of follow on. So we have between sort of $500,000 and up to, $4 or $5 million in any one company, depending on where they're at in that stage and how much we followed on. But generally, the first time they're going out to raise money, they're raising probably between $2 and $6 million. And we might write, $1 million or $1.5 million of that round and then have other investors come in alongside us. So that's sort of the first check. And then, they move on from there to raise, maybe 6 to 12 and 12 to 25 and sort of go from there.
So then if I was wanting to invest with you guys, who are the types of investors? Like, do you take private investors? Do you take just people listening to the show? Are we the type of people that would invest with you?
I mean, we absolutely have, kind of individual investors. The class of investment that would be venture capital is obviously wholesale and sophisticated kind of investor. So, sometimes we will, have communication directly there. Sometimes they will come through a wealth advisor. But absolutely, as part of a sensible allocation strategy that they're probably getting advice over, then, they will direct invest in the fund. I mean, I think one of the advantages, if you like, of our sector-specific fund is like it's sort of tech, it's definitely VC, but also it's ag and food. And so there's sort of an uncorrelated element to it as well. So again, if someone was thinking about sort of portfolio construction with their advisor, there might be, a number of reasons why it would make sense. I mean, there is a range that we have institutional investors, we have family offices, we have high net worth individuals, people's self-managed super funds. The allocation reason can be pretty wide and varied. One of the great things about we love having close relationships with some of our LPs, and some of our LPs are active farmers. And so there's a fabulous kind of symbiosis there where, we learn a lot from them. They obviously get potentially kind of to see what's happening before it's quite ready for them to use. So people who are connected with the agri-food system as well, make for great limited partners.
They would love it because they get to see where their industry is going and also to maybe try it, right? Like to be a use case early days. So connecting those dots is so important. And there's a lot of people that listen to this show. I'm always surprised in the Rask community how many people have a really strong appetite for these, but also have the funds available. There's a lot of people that listen to these shows that have a lot of property wealth. They have a lot of business wealth in a formal life. And they're at that kind of mini family office stage and they don't really realize it. They've got $5 to $10 to $15 million of disposable assets. And they're thinking, well, yeah, I can do my ETFs and my index funds and I can do all these types of things, my stocks. But what else is there? And we talk a lot about private markets in particular this year. And this is definitely at the most exciting end. And it's at the end where it's probably most relatable to the Australian consumer, Australian investor, because of what you guys are doing and what you're supporting. So it's super interesting. I'll put links in the show notes, by the way, to the podcast, to the form that you mentioned, Sarah, before about how people get in touch, whether they're founders or investors. I'll put all of that in the show notes because it's a really exciting place that you're playing in and you're doing it really well. I've probably got one more question for you. And this is more just like, sometimes it's kind of crazy, but sometimes ag tech can be the stuff of science fiction. Like you can kind of imagine like robotic workers on farms and all these types of things. And you guys are so close to this. So maybe I just wanted to ask each of you, like if you could paint a vision of the future of like what could be like moonshot style, what's something that's always like, you're like, oh, that's really exciting. Like, what's something that's like, that's the future of this, or it could be the future of this? And I don't know, maybe we can start with you, Matthew. Like, what is that?
Yeah, I mean, for me, so one of our portfolio companies in Fund 1 is a company called Jupiter Ionics, and they are a spin out of Monash University. Everyone knows that, crops need fertilizer. Nitrogen is the core element there. They have a technology that at a high level basically can take sunlight, air, and water and create ammonia directly, which can be used as a fertilizer. And so it's literally magic. Imagine a couple of shipping containers and a bunch of solar panels and just being able to create as much fertilizer as you need. Now, there is a whole heap of technical risk there, trying to bend and twist the laws of physics and chemistry. But if it works, it's amazing. Like a small regional town could have a depot and basically could be able to produce as much ammonia, and obviously ammonia can be used as a fuel and a whole bunch of other things. So like in terms of really big picture stuff that, both is incredible technology, but also could have really significant kind of regional economic impact, then I think that's a super exciting thing.
Wow, it's kind of like imagining Wi-Fi before it was a thing. Like this thing just kind of comes out of the air. And
Correct. Correct.
That's wild. That's wild. Sarah, I don't know if you have any, but if you do, I'd love to hear them.
Yeah, for me, there's a lot of debate around red meat consumption in particular, and should we eat animals from an environmental and climate perspective? And yet there's also a whole argument that says like livelihoods are based on this, and both farmers and consumers. And so I really love what we do because the technologies can start to break some of these trade-offs where we're no longer having these black and white debates of like meat good, meat bad, and can actually create technologies where the cows no longer have the same kind of footprint from an environmental perspective because the genetics are improved much faster. So we have a company in our portfolio called Nbryo that rapidly improves the genetics of cattle, and there's emerging evidence around selecting for traits like anti-methanogenic properties, and so they're not producing methane anymore. So benefits to farmers in terms of resilience and profitability, and then taking away this debate for consumers. Same thing with Earthodic and the packaging. Same thing with Goterra and the waste. And so that's something I'm really passionate about, is giving people better choices without a compromise on economics, where we can vote with our dollar, but it's not this sort of it costs more, we have to pay for it. It's because it makes economic sense too, and we just see so much potential for that.
I just love these ideas and these businesses that you back. I'm sure there's a round 2 podcast in the works for some time over the next few years, but I know you two are super busy, and I really appreciate you taking the time to share some of your time with us and give us these insights. Again, you've got the podcast, which I can direct people to if they're hungry for this type of thing now. That will be in your podcast player, so go and click that link and subscribe to a few episodes. It's really exciting what you guys are doing, and I wish you all the best with it. And once again, thanks for taking the time to join me on the show.
Thanks heaps. Cheers, on.
Yeah, thanks for having us.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.